It's February 1, 2023 in New York City, and prices are on display in the grocery store. We take a look at the latest news about the release of this month's Consumer Price Index, or CPI, and it looks like it could show that inflation was strong, perhaps even stronger than expected. But what does this mean for the Federal Reserve, inflation rate, and investors? The CPI, which measures the cost for dozens of goods and services, had been trending lower as the end of 2022 came but now looks set to show a change in the market. Economists currently expect the CPI to show a 0.4% increase in January, with annual growth coming in at 6.2%, but there are indications that the number could be higher. The Cleveland Fed's no-cash tracker of CPI components points to inflation growth of 0.65% monthly and 6.5% year-on-year, with a core of 0.46% and 5.6%, respectively. So, why does the CPI matter? Fed policymakers are watching it and other data points for an indication of whether a series of 8 interest rate increases have cooled inflation, which hit a 41-year high last summer. If monetary tightening isn't having an effect, the Fed may be forced into a more aggressive position. Mark Zandi of Moody's Analytics cautions not to read too much into any one CPI report, with month-to-month fluctuations often occurring. In terms of immediate market implications, if the CPI reading this month is higher than expected, it could lead to the Fed increasing their target interest rate even higher than their current level of 4.5%, 4.75%. Market pricing suggests that this could reach 5.18%, leading to a further tightening of the belt. The CPI report also has a few changes this month, with the BLS changing its methodology to compare prices on a one-year basis instead of two, and also giving weightings to rental property housing. At this time, the CPI numbers have remained stubborn, with food prices still up more than 10% from a year ago in December and gas prices increasing by almost 30 cents a gallon. This month's CPI report could be a market-moving catalyst for the rest of the year, with investors and central bankers alike watching the indicators closely. Trends in the CPI will remain the key indicator of inflation rate and consumer costs, and will help to decide the future of the central bank's monetary policy. So, be sure to follow along with the latest numbers and their implications. Your finances depend on it.